Everyone, thank you for joining us. And Michael, to kick things off with you, how would you define active management?
Yeah, so at ClearBridge and with Dividend strategy, our approach is about the type of outcomes and objectives we're trying to achieve for our clients. And what we mean by that is that with our Dividend strategy product, the approach is not so much about how are we going to do compared to a benchmark, but can we create a portfolio, a diversified portfolio of high quality companies with an attractive yield today that'll compound income growth over time and do it in a low risk conservative manner. And the importance of this is that while obviously it's important to measure everybody against benchmarks and to consider performance relative to the indices, we also have to remember what the objectives are that we're trying to achieve for our clients or the original purpose of investing. Investors, yes, they care about how they do against an index. What they're really trying to do is not compare to an index, but try to save for retirement or achieve some longer term financial objectives. And so, what we're trying to do with Dividend strategy and what our active management approach is all about is, again, to build a portfolio that's highly diversified from a risk perspective, that throws off an attractive current coupon, and that can compound returns and capital appreciation in a low risk manner over a very long period of time. Because the objective here is to help people save for retirement 10 or 20 years from now. And that's really what the focus is. And I think you would contrast that with passive, which I think we're all aware is becoming such a bigger and bigger part of the investment world. And there, the real focus is less about achieving some sort of long-term objective that's stated up front, and more just about mirroring or copying an index or a benchmark. So it's really quite different. And I think it'll be interesting to talk more about as we go forward. I think the differences between active and passive management become even more relevant and are brought into greater relief at turning points or points of volatility like we're seeing now in the world and in the markets.
And Michael, people love to debate active versus passive investing. It's already come up here. What makes active management unique, in your opinion, compared to passive?
Yeah, I think as the other panelists have mentioned, in today's world, it's not a question of either or, right? Clients are using both and for different things, and appropriately so. I think the emphasis, what we believe make active management so important is particularly times like the ones we're in right now, where the trends that we've had for many years are changing. We still don't know exactly how all these things are going to play out. But you have big uncertainty in the world from the pandemic. You have big uncertainty in the world from change in central banks and government spending. You have big political risks and social unrest. And as Brian said, different about something different, but we have the opportunity to make choices here about do we want to reposition meaningfully? Do we think that the world ahead is going to be different than the world behind? It's a very rich opportunity for active managers to make those decisions. Now, with those choices also comes risks. People could make the wrong decisions. It may turn out that the pandemic is worse than people fear. They're not nearly as bad, or all of these things. There's so many different permutations to how things play out. But I think that the time we're in right now particularly underscores the importance of active management and the role it should play in terms of clients finding management firms and management teams who invest in a way that's consistent with their view of the world and the types of risks and approach that they're looking for with their investments.
And with the coronavirus pandemic, what kind of challenges are active managers facing in this environment? How is COVID-19 impacting active managers?
With the scope of the rally that we've had, the market seems to be pricing in some pretty positive outcomes, in terms of how quickly things get back to normal and maybe how quickly we have some therapeutic tools for dealing with COVID. And we hope that that's right, but there does seem to be some risk there if that isn't the case. Sort of similarly in the equity markets is what they're thinking about on the fixed income side. It's a focus on, as we're putting together our investment cases, it's how do we think about the short term in terms of navigating this period of volatility and choppiness and uncertainty, and then the longer term. And for many companies, you could break it down into there's a handful of companies who have really, very little impact from what's going on. If you're Verizon, for example, everybody's still using their cell phones. It hasn't really changed their outlook. There's a whole host of companies who have short-term impacts that seem pretty significant, but longer term, we don't have a whole lot of doubts that they will ultimately return to something like like they were before all this, and that they have the financial wherewithal to get to the other side And then there's a third bucket of companies that, we're just not sure at all whether that, what business looks like on the other side and can they get there. And I think that, again, the market has bounced so quickly. I think that caught a lot of people caught a lot of people by surprise at the bottom, and now I think people are having the opportunity to reposition in light of what's priced in, which seems to be a fairly benign scenario. Which again we hope is the case, but may turn out not to be.
Yeah, the stock market seems like it wants to make this a V-shaped recovery.
Certainly does.
And Michael, many active managers have underperformed the benchmarks this year. Why do you think that is?
Yeah, so I think in large part it's because of a continuation of the trends that we saw that were in place before the downturn, which is I think we see it all over the place in terms of financial news that talk about how narrow the stock market is, how much of the indices are made up now of these platform companies that are absolutely wonderful companies from a financial return and growth perspective. The Amazons of the world, the Googles, the Microsoft, Apple, Netflix, and go on and on. Those companies have become such big parts of the index that in order to be overweight, in order to beat the index when those stocks are doing well, you have to have very large positions there. Those stocks have been proved very defensive so far in the downturn, in large part because work from home may have even reinforced some of the strength these companies had. And also because as people have gone to the safety trade has actually gone to areas that are sort of unusual or are different than in the past. So what's been unusual is that normally or frequently we would think that in a downturn, the things that have been the leaders before may roll over the hardest because they seem extended. And rather, what we've seen this time around is that in this downturn, in the midst of volatility, people are flocking back, even more to these internet champions. And there's parts of that make sense in terms of, these companies have phenomenal balance sheets, tremendous cash flow, they're highly profitable. At the same time, when we look inside the market and see things like how is growth priced relative to value, we see that that's incredibly extended, and sort of that in some ways the market looks the most extended in those sorts of measures as it's ever been. And so I think what's been challenging, just to reinforce the answer, is that the strength of the indices have been driven by a relatively narrow group of companies that have done phenomenally well. And I think as long as that trend is in place, it's challenging for active managers to outperform against that. I think the opportunity here, should it present itself, is to the extent that this really does seem to provide a turning point in the market and a shift in paradigm. What's worked for the last many years, well, it's tempting to think it will go on forever. Ultimately, it won't. And what's going to work in the future? And I think that's the opportunity.
Michael, what would cause this dynamic to change for active managers to outperform?
Yeah, I think, again, it goes back to some of the things I started with earlier in the program, which is just the tremendous amount of uncertainty. We go back to just on the health front, on the economic front, both fiscal and monetary policy, on the political front, on the social unrest front. I mean, each of these things in and of themselves would be big enough on their own, and then you throw them all together. And yet, as you said, the market wants it to be a V, and they're getting a lot of help in that regard from the central bank and from the government that is, providing a lot of stimulus to the markets, which is the appropriate response. What creates the opportunity for active managers is that people are still largely investing like it's February of 2020. I mean, not entirely, for sure, not in restaurants or airlines or hotels. But many of the trends that were in place back then have just have been reinforced. And I think the question, the jury's out: is this a real turning point? And are we at a real point of sort of paradigm shift for capital markets, the economy, political environment? But to the extent that we are, there's a real opportunity there, and also a lot of risk.
Great point. And Michael, where are you seeing opportunity from the recent sell-off?
Yeah, so I think one of the areas that has surprised us a bit in terms of providing opportunities is actually in regulated utilities. And what surprised us is that regulated utilities is something that you think would be very well positioned for this type of environment, in the sense that there should have relatively less economic sensitivity. There's a predictable return structure, and many of these companies have very visible, secure growth rates in the future from sort of long-term plans that they've submitted to the regulators and approved. And nevertheless, utilities sold off very hard in the downturn. And so from our perspective, again, going back to echoing much of what's been said so far, The market seems to have this very benign view of how things are going to play out. And from a risk adjusted perspective, it strikes us that some of these regulated utilities would provide a pretty attractive risk adjusted return. You have the ability to get a 3 to 4% upfront yield and earnings growth in the 6 to 8% range for the next many years. And we look at that and say the combination of pretty nice upfront income, 6 to 8% growth with a pretty low risk profile, given all the risks and uncertainties we're talking about, seems like a pretty attractive place to be.
Michael, what do you make of the powerful market rebound, and do you think that stocks could be getting ahead of themselves?
I think we do. We do think that there's a real risk that stocks are ahead of themselves. We're not surprised that there was a rebound. The amount of negativity that was priced in at the bottom in March was severe, and the amount of stimulus we've seen, both from a monetary and fiscal policy perspective, has been sizable, and we thought would work in reversing much of the downdraft we saw. But yeah, we do think that the markets are ahead of themselves. It seems like in many cases it's just pricing in essentially a best case scenario. And I think the answer as to why, again, is not surprising, is the tremendous amount of liquidity in the fixed income markets and spilling over everywhere else from central bank actions. And so, I think we're hopeful and optimistic that what's priced into the markets may actually become the reality, and all of us can get back to our normal, healthier lives quicker. But I think we're cognizant of the fact that the risk is very real, that it's not, and that from a risk reward perspective, the time to take a lot of risk is when you're being paid to, and right now it doesn't feel like we are.
And Michael, during these sharp drawdowns like the one we just experienced, how do you assess the impact on individual companies and sectors? Can you walk us through your stress testing approach?
Yeah. So, importantly, I think the work we do here starts long before the drawdowns, in the sense of hopefully picking companies, industries, and sectors that are well positioned to withstand big downturns in the economy and the markets. And that starts with things like evaluating balance sheets and capital structure, free cash flow, sustainability of dividend payout ratios, and sort of economic sensitivity and cyclicality of the business. So again, importantly, that starts beforehand. Then obviously, during the downturn, you're reevaluating those things. I think one of the things that's been so interesting and surprising and challenging and painful about this downturn is it's unlike anything we've seen in any of our lifetimes. In the sense that certain things that we didn't realize how much risk there was, because nobody ever thought that the entire country would have to stay home for 3 months and shut down things. So interesting things like gasoline demand, which historically has been very stable, and I think in the worst downturn you've ever seen, it only been down 1 or 2% before. So very stable utility, like gasoline demand, I think in April and March was down 30 or 40%. And so all of a sudden, the business, if you were a pipeline that moved gasoline, for example, that had been, your worst downturn you've ever seen in 40 years had been 1 or 2%, and all of a sudden your business was down 30 or 40. That's something. Or again, you think about things like restaurants, and we thought, well, in a downturn, your comp sales might be down 2 or 3%. You didn't think that restaurants, would just be closed. We didn't own a lot of restaurants, so that's not a particularly specific thing to us. But just as an example, this presented risks that people had never really expected. So I think that's been one of the challenges. And I think so. Again, the work starts beforehand in terms of the kind of businesses you want to own over a cycle, by evaluating balance sheet, capital structure, cyclicality of business, sort of economic sensitivity, and then during the downturn, as things are playing out in real time, you're reassessing in light of this new risk environment that we're in, of people staying home and what all that means, and socially distanced for an extended period of time, reevaluating that on a business by business basis. And again, it focuses most intensely in the downturn, in the crux of it, on sort of balance sheet and financial sustainability, and then thinking longer term about what a business looks like in this new world.
Michael, how do you apply your active approach to selecting dividend paying stocks? Do you prefer to focus on dividend growth or current yield?
Yeah, so it's a balance of both, and it's as much an art as a science. And so what we try to do with our portfolio is to provide an attractive upfront yield, but the real emphasis is on marrying that with dividend growth and powerful dividend growth. We think the real benefit of equity income investing is not the current yield, but the ability to grow the income over time. And so over a very long period of time, our portfolios have been able to grow their dividends at a high single-digit rate, which we think is really powerful in terms of what that can mean of compounding of income over time. Another key part of investing and being a dividend investor is focusing on the sustainability of dividends. So we spend a lot of time evaluating that in terms of what's a company's payout ratio, what's their free cash flow generation look like, and what's their balance sheet look like to ensure that in a downturn, they'll be able to continue to pay and even grow their dividend. And I think we've seen that and been relatively pleased with that to date. So in the first half of the year through the downturn, I think about 60 companies in the S&P 500 have cut their dividends. And actually, out of the 500 in the S&P 500, only about 400 of them paid dividends coming into this. So about 15% have either cut or skip their dividends. And in our portfolio of 50, we've had one, which is Disney, who skipped their recent dividend payment. And it just goes to show the uniqueness of this downturn. That the one company in our portfolio that suspended its dividend was Disney. If you had asked us 6 months ago to rank companies at risk of not paying a dividend in the next downturn, Disney wouldn't have factored on the list. Very high quality company, great balance sheet, a lot of recurring revenues. But when you shut theme parks, you shut movie theaters, you shut sports, all of which we didn't really think as being a high likelihood of coming to be, it was the prudent thing for them in the depths of this to do that and then revisit in 6 months.
Michael, why does a focus on dividends make sense in such an unsettled environment?
Yeah, I think we believe dividends. As dividend investors, won't be surprised to hear this, but we believe dividends are always important and should always be a core part of equity investing. But really, right now, I think there's a few reasons. I think the first would be number one, just from an income perspective, with interest rates as low as they are. Um, you know, the yield you can get from high quality equities is very competitive with what you can find elsewhere. So number first is we think there's a relatively attractive income story there. The spread of high quality dividends over treasuries is close to as high as it's ever been. I think the second thing is that with the tremendous recovery we've had in the stock market, and with our expectation that absent the short term fill up the economy is going to get from reopening, we expect a generally lower growth environment in the years ahead than we had before, which wasn't a particularly great growth environment as a starting point. So with pretty full stock market valuations and a relatively lower growth global economy, we think that more and more of the return you get in equities from here is going to come from the income component. And then the last piece would be to the extent that any of us are proven right, and that the markets become more volatile and start to reflect more of the challenges and less of just the liquidity support. Dividends should provide some support in a choppier market to the stock prices in terms of valuation support and downside protection. So I think there's a whole host of good reasons to really emphasize dividends now, even more than ever.
And finally, Michael, where do you think the industry is headed? Any trends that you're watching with dividends or active management that you'd like to highlight?
Yeah, I think in the near term, I think sort of maybe two trends. I think the trend that we've seen towards passive and indexing, I think continues. That's been ongoing for a very long time, and we certainly think it'll run further. As we've talked about before, we don't think that it's a one or the other. That investors have to choose. There's places for both. I think one of the things that's become interesting about that trend is that there's some old proverb, and I don't mean this to sound dismissive about it because I don't, but what the wise man does in the beginning, the less wise person does in the end. And with indexing and passive, again, it's not a negative, but we're getting to a place. I think we've recently got to a place where roughly half the money in the stock market is passively managed. In other words, tracking an index. And I think longer term, it raises real questions for capital markets and society about what that happens. I don't think we're yet necessarily near sort of judgment day for that, and where we'll find out. But increasingly, the more and more that society allocates capital like that, it could have longer term ramifications. It very well may not, but it could. And I think that's a question that bears watching. I think the other thing we've been focused on is alternative asset managers. The lower return world that we're in, particularly on the institutional investor side, has made it more and more challenging for them to hit some of their bogeys and targets. And we're seeing investors shift more and more money into alternatives. One of the interesting things, and one of the things we've been able to play in that regard, is that increasingly some of the alternative asset managers are publicly traded and traded as corporations. So we've been able to invest there. We've done so, and we think that well, it's been a great run so far. We actually think there's a long way to go. We think the retail investors are just starting to get access to that alternative asset management product. And while we don't ever think that'll be, the majority by any stretch of retail investors' portfolio, there's a huge pie out there of retail investors' asset allocation that really, going from a very small starting point, could become much more meaningful and see a lot of money flow into alternatives. I think that's one other thing we're looking for.